I love the smell of ruffled feathers in the morning. And that's exactly what this video is going to do today. Hey, it's Matthew Decker, Leveraged Wealth Management. Today we are talking about a highly controversial topic, especially if you get into the serious financial planner world, and that is infinite banking, sometimes known as becoming your own bank. So this idea, or this sales strategy is what we're going to call it. This sales strategy was popularized by a lot of different people. You may have heard of Nash, Pamela Yellen. There's a bunch of books written on this topic, and there's huge organizations with tons of acolytes all drinking Kool-Aid selling this particular strategy to consumers. And so we have to do a video on it on Takedown Thursday because it is a strategy or a concept that is widely misunderstood, number one. And number two, when I come in contact with it, it's almost always sold in a vacuum. And if there's one thing you want to make sure you avoid when it comes to making financial decisions, it's making financial decisions in a vacuum surrounded by people who don't have your best interest in mind. That is a recipe for disaster. So I'm going to do my best on this infinite banking, be your own banker topic. But I got to tell you, it's going to be very difficult. And the reason it's going to be difficult is because there's thousands and thousands of hours on YouTube. There's hundreds of thousands of articles. There's hundreds of books written on this topic that are already filled to the brim with half-truths. And so I'm going to have to trudge through the BS in order to come up with something that is boiled down into a coherent argument as to why I think this particular sales strategy simply doesn't work, caveat, when you compare it to other things that are available. It might look good in a vacuum, but once you start comparing it to other viable financial alternatives, it starts to very quickly show itself for what it really is. And that's a sales strategy that sounds sexy, that might look good, but it's so complicated and so complex, it can actually be easier to sell than something simple because it's very difficult for you, the consumer, to do a true apples to apples comparison on this strategy, comparing it to other alternatives. And so that's what we're going to do today. And we're going to do it in one of the Be Your Own Banker, infinite banking, in their own terms. And so if you read the original book written by Nash, which I don't even know when it was written, I think probably 20 years ago, maybe more. They use a very simple example of using your life insurance policy to purchase a car. And they show you the financial benefit of using your life insurance policy to purchase a car versus going to a bank and getting a loan. And so what I want to do today is I want to deconstruct that example. And I want to show you what it's going to look like when we actually start comparing it to other alternatives. So I'm going to get my whiteboard up here, and we're just going to go ahead and kind of outline how this strategy works, how it's sold, and what the pros and cons are, and where we end up is where we end up. So here we go. So here's the general concept of becoming your own banker, infinite banking. And that is you start with some dollars, and over a period of years, you pay those dollars into a whole life insurance policy. And so maybe you pay these dollars in over 3, 4, 5 years. It doesn't really matter the time frame here. The point is you are funding a whole life insurance policy with your money. And then what the sales strategist or the salesman would say is, okay, well, now that you have this funded life insurance policy, you no longer need the bank in order to access funds via loans. You actually have this life insurance policy where we can go ahead and we can take a loan from this policy in order to do things like buying a car. So here's a bad car, right? We got I don't know what's happening here. Let's just say that's a car. Wow, that's really ugly. Let's do a little bit better here just because we can. Okay, that's a little bit better. So you're buying a car. And you're going to use your life insurance policy to buy this car. And the way that you're going to do that is you're going to take life insurance policy loans. So we've got our whole life insurance policy there. We're going to loan money out of the life insurance policy to pay for the car. And then the pros of this strategy is this loan that happens there is no structured terms to the loan. So you're not forced into a repayment schedule. You get a car loan, you're forced into a repayment schedule. With your life insurance policy, that's not the case. You're not forced into a repayment schedule, and all of your money is actually still at work inside the life insurance policy. It's going to continue to earn interest. And so what you're actually doing is you're leveraging your dollars. That's all that you're doing in this strategy, is you are leveraging your dollars because you're using the bank's money or your life insurance policy money to purchase the car, while the money in your life insurance policy continues to grow. And then over a period of years, you're ultimately going to then take your dollars and you're going to pay back your life insurance policy loan. And since it's an unstructured loan, you can do that over 2, 3, 4 years, 5 years. You can do it as long as you want. But most proponents of this infinite banking concept, they're going to talk about the velocity of money. And so what they're going to say is you're going to want to pay it back quickly because you're going to pay yourself back the interest. You're not going to pay the bank back the interest. That's kind of the way that the strategy works. Let's get rid of the big greedy banks. They're making interest off you. Instead, pay yourself the interest by using your life insurance policy. Okay, so let's pause right there. The first thing that we just got to discuss is the fact that you're not actually paying yourself the interest, because your whole life insurance policy is just like any other institution that would give you a loan. When you take a loan from the policy, they do charge you an interest rate. And so when you pay the loan back, you pay it back with interest, and the company actually receives the interest. You don't receive the interest. So just philosophically, do you care who gets the interest off your loan? Do you care if it's the bank or the life insurance policy company? Do you really care? Most people would say, no, I don't really care. In fact, the bigger question is, what is the rate that's being charged in the life insurance policy versus what is the rate that's being charged from a bank? So here's what we're going to do. I know that this is really high level, but we're going to look at an actual example of how this might work if we take a policy loan from a life insurance policy, and typically this is done with whole life. So we're going to take a whole life insurance policy loan, we're going to buy a car, and we're going to compare how much cash we have left over when it's all said and done. So here's our whole life insurance policy that we've got here. Let me just get set up to draw for us. So this is a really good whole life insurance policy as far as whole life insurance policies go. We've got a really good blend here of how much base coverage versus supplemental rider we're using here. So a lot of the cash, in fact, $27,000 of the premium is going towards this LISR, which is good because it makes the policy really efficient. We've taken out a lot of the fees here. And so we've got a $33,000 premium for 5 years. Then we hit some MEC limits. We're down to $30,469 in the 6th year. And so this is what we discussed kind of at the front end of this video. In order to get started in these policies, you got to front load it a little bit, get some cash in there, and now we're gonna velocity this money up. We're gonna start loaning out of our life insurance policy to buy a car, because that's the example that Nelson Nash uses, and so that's the example I want to use. So we're going to buy a nice car. $50,000 in annual loan is what we're going to take out in the 7th year. And since this is an unstructured loan, we're not going to pay anything in interest or towards the loan in that first year. And the reason we're doing that is because it's just easier to see on this illustration if I separate it out that way. So we're not paying anything in that first year. We're going to pay back the full loan over years 8 and 9. And so if we look here, you can kind of see we're paying back the full loan over the next 2 years, to the point where in that 9th year, we no longer have any outstanding loans. Now, the way that this policy or this strategy is sold is loan money out of here and you're going to continue to earn interest on your dollars. And that's absolutely true. In fact, the dividend on this policy is unaffected by policy loans. And that's pretty cool. You actually aren't affected by policy loans in taking, you still get to earn interest on your money. So that's cool. That is true. That does work. You get to earn interest on your money when you take policy loans from this contract. What they don't tell you though is, let's compare it to something else. What if we did something else? And so the comparison that I want to make is in this 10th year, after our loan is totally paid back for the purchase of this car, how much cash do we have left over in the 10th year and in the 20th year? Because that's what matters. And so we've got $268,000 in net cash in year 10. In year 20, we've got $474,000 left over in cash. So on the face of it, the sales strategy of being your own banker, infinite banking, looks good. You put money into a policy, you take money out, you don't have to get approved from a bank, you don't pay the bank interest, you pay yourself the interest back. That's how it's sold. And your money continues to earn interest while that is all going on. And really, it just becomes a game. How fast can you spend this money and how fast can you pay it back? And your dollars continue to earn interest all the while that's going on. But in order to do an actual real comparison, we have to figure out if this works when you stack it up to the traditional method of simply going and get a loan from a bank. So what exactly would that look like? So what I did is I went out to my local credit union and I asked them what some rates were on car loans. And this is what I got. You can see there, car buying service, auto loan, new auto loan. And if we go with 60 months on a repayment schedule, we are looking at 1.24%. 1.24% APR for a car loan. And so the question becomes, if we do a real apples to apples comparison of saving the $33,000 and change that we had to fund that life insurance policy with, if we do a real comparison of saving that money, and then in 7 years from now, we go and we get a car loan and we use interest rates as they're available today, let's just call it the 1.24%, where do we end up at the end of this? And so I want to show you my methodology here. So what I did is I just went out to a real, simple financial calculator that you can find online where they talk about, how much is this car loan going to be shortened if you pay extra? Because if you remember, in the whole life insurance policy, we basically paid that car loan off in 3 years, though we skipped payments for 1 year. Okay, so this is how this is going to work. We are going to pay the normal balance or the normal payment towards this auto loan for the first year. And then we are going to accelerate our payments similar to what we did in the life insurance policy. And the way that works, and so we're shortening it by 2 years. So we're taking 3 years to pay off this car loan. We're saving $523 in interest. Yay. It's hardly anything because interest rates are at 1.24%. So we've got our 1.24% right there. It's a typical 60-month term. We're 12 months into the term. And then we're going to accelerate it by paying an additional $900 a month for 2 years on top of the $859. So all I've done here, I know I'm going through this fast. All I've done is I've said, what if we get a car loan for $50,000 and we pay that car loan off in 3 years, just like what we were doing in the life insurance policy, where we pay the car loan off in 3 years. We just skipped payments for the first year. So really we did it in 2, but we took 3 years to do it in 2. And so that's the comparison that we're making. And so what we then have to do is we have to figure out, okay, well, if we're paying all this money towards the car loan in this scenario, I told you that we have to save this $33,000. And so where are we going to save this $33,000 for the first 7 years? Well, I thought it would be cool if we just compared a really simple stock portfolio to an indexed or to a whole life insurance policy. And that's pretty easy to do. We have clients that have money and we have standard deviation and mean returns. And so we can take a conservative portfolio, we can plug in some numbers. And I thought it'd be really cool to do like a live Monte Carlo test just to figure out where we're going to end up. So that's exactly what we are going to do. So let me just recap. What you're about to see is funding an account for $33,445 for 5 years, then $30,469 in the 6th year, and then this $5,700 premium in these years here. And the idea is, how much money can we end up with in a stock portfolio that's it's a moderate stock portfolio. It's not even that aggressive, but in a moderate portfolio, if we save the $33,000 a year on the front end, and then we go out to a bank to get a loan for this new car for $50,000, how much money can we end up with in the end? Because what we're comparing against is in 10 years, we have $268,000 in the life insurance policy, and in 20 years, we have $474,000 left in the life insurance policy. So if we Monte Carlo this thing out, what is it going to look like? So when we get to this Monte Carlo sample, I want to just point out what we're looking at here. So these returns, it's generating these returns for me based on the risk profile that I give it. And so these numbers are going to vary quite a bit every time I run the simulation. And so if you can see here, I've got this equals normal value, 955 and 11%. So what this means is this is a moderate portfolio where the mean return over the last 10 years has been 9.55. The standard deviation has been 11%. And so if I rerun this, all these, in fact, I'll just show you. The numbers will change. We're going to run 5,000 simulations. All of a sudden, the numbers change. Okay, now we've got four negatives in there. It doesn't matter. What we want to focus in on is we've got the same $33,000 payment going in for 5 years, then $30,469 in the 6th year, and then we've got that $5,757, which is the maintenance premium on that whole life insurance policy. And what we're doing is we're building up this account, and then in the 7th year, we're going to go get a loan from a bank. Now, you don't need a life insurance policy to get a loan for a bank, especially for a car, because the bank is just going to hold the car as collateral. In the infinite banking concept, if you do decide to use your life insurance policy to go get a loan from a bank, the bank's going to hold your whole life insurance policy as collateral, which seems really stupid to me because you've got way more cash in your life insurance policy than $50,000. So why would you over collateralize life? Anyway, enough of that. What we're doing here is we're simply running a Monte Carlo simulation. So it runs these returns 5,000 different times with 5,000 different random variables based on a mean return of 955 and a standard deviation of 11%. That's a fancy way of saying it's simulating a sequence of return risk that you might find in the stock market based on a portfolio that has an average mean return of 955 and a variance, or it's actually standard deviation. Variance is a different variable, but a standard deviation of 11%, meaning 955 is the average, but it could be plus or minus 11% in terms of its window of returns within one standard deviation. This is a statistics term. If you want to learn more about it, you can find out all about it online. But what I want to focus in on is number one, our average closing balance, because that's what matters here. Because if we're going to run a Monte Carlo simulation, we can't just run it once and then say, oh, that's our balance at the end of the year. Did it win or did it lose? No. We're going to run 5,000 different calculations. And in the 5,000 different calculations, the absolute worst one ended up with a balance of $167,000. That's worse than the whole life insurance policy. Why is it worse? Well, because we're throwing it through random variables. There could be tons of negative returns in there. We don't know. It's 5,000 different random sequences of returns. The worst one of the 5,000 trials ended up with $167,000. The best one ended up with $859,000. So of the 5,000 simulations run with random variables for that 10-year period, the highest cash value or the highest account balance at the end of those 10 years is $859,000. The average closing balance, if we put them all together, all 5,000 simulations, all 5,000 closing balances in the 10th year, our average closing balance is $396,000. And I just want you to see how little this changes the more I run the simulation. So 396,861. Let's do another set of 5,000 iterations, and we're at 396,866. Closing balance 395. Let's do it again. Another 5,000 iterations. We're at 397 in our average closing balance. Ending balance 416. And look, our highs and lows are virtually identical, 169 and 914. Let's do it again just for fun. Because as you can see, it doesn't matter how many times we do this. The numbers are the numbers. You have an average rate of return. You have a standard deviation. It pumps out random variables of pluses and minuses. It's simulating investment returns, and our average closing balance is always going to be in the 390s because it has to be, because that's how statistics works. And our minimum closing balance and our maximum closing balance are always going to be something in the hundreds and then something over, let's just call it 700,000. That might be, I don't know, let's run it one more time and see if we get lower than 817. That was the lowest one we've had so far. No, 930. So I think that's pretty safe to say. Average closing balance of $396,000. So let's use that number because of the 5,000, that's the middle. So if you funded a stock portfolio that's moderately aggressive, and in the 7th year you went out and you got a bank loan to buy this $50,000 car, and you pay that back over the same 2 years, except we're doing 3 years, As you pay that back over 3 years, your average closing balance, if you just go with a moderate portfolio, is $396,000 versus in the life insurance policy, you're at $268,000. I mean, we're worlds different away in terms of how much cash you have in 10 years. And this is exactly why you have to compare this strategy to something else. It's never compared to anything. Why? Because it's difficult. I mean, I would almost guarantee you there's nobody out there selling infinite banking or banking on yourself that knows how to run a Monte Carlo simulation. I mean, there's probably somebody out there, but I doubt it. Highly doubt it. So anyway, what some would say though is, well, but look at your minimum closing balance. You have $162,000 minimum closing balance, which means there was a trial in there of the 5,000 random set of variables that were chosen. The very worst one actually had less money than the life insurance policy. And that's absolutely true. Yes, it does. Well, you're taking a little bit more risk. And for the risk that you're taking in the stock portfolio, there's going to be some people that don't beat the life insurance policy simply because they have a bad set of timing. You know, maybe the market dips by 40% in the 10th year. And if that happens in the 10th year, your account value gets almost cut in half, and then all of a sudden the life insurance policy wins. So some people who sell infinite banking would say, well, that's exactly why we use the life insurance, because it's safer, and so we know what we're going to get. And to those people, I say, you're right. It is safer, but is whole life even the best life insurance vehicle to be using for this strategy? And so let's take it one layer deeper. What if we used an indexed policy instead of a whole life policy? Do we end up with a better set of values? So I've done the exact same thing here in this Symetra indexed policy. And actually I've used maybe like $300 less in premium in this 6th year here just because of some mech issues. So we've got basically the exact same policy here, $33,445 for 5, then $30,191 in the 6th year, and then that maintenance premium of $5,700. And how much money do we end up with in the 10th year? And I should add, this would be, still going out and getting a loan from the bank, because why would you get a loan from your life insurance policy if they're going to charge you between 4 and 7% for your money when you can get a loan from a bank and they're going to charge you 1.24? That math is easy. I don't need to do that for you. So we're going to get the loan from the bank, and we're going to pay that bank back over the 3 years, just like we did in the previous example. And when we do that, how much cash do we have in the 10th year? We have $275,000 in cash in the 10th year. In the life insurance policy, the whole life policy, we have $268,000. And if we go out even further to year 20, we really start to separate the two. So Symetra, in the 20th year, we have $577,000 in cash. In the 20th year, in the whole life insurance policy, you have $474,000 in cash. We're talking about the difference of $100,000 over a 20-year time period just by simply using a product that has a slightly higher risk profile but a much better expected return profile. And so I just want to bring this video to a close. I know that there's going to be tons of haters in the comments, and I know by and large the haters in the comments have no idea what they're talking about, so that's totally fine. And to reiterate what I'm saying, I do research on these videos for YouTube, and I've got some tools that I use for keywords. When I put in the video title to publish this to YouTube, it suggests tags that I should use for search engine optimization. And when I put in infinite banking, I do this all the time. I do Roth conversion video, it gives me suggested keywords. I do a video on index life, it gives me suggested keywords. I do a video on whole life, suggested keywords. I do a video on infinite banking, and it gives me a list of suggested keywords. And of the 30 to 40 suggested keywords that it gives, over half of those keywords are misspelled. Over half the keywords are misspelled. So you take from that what you will. When I see that, I know that I'm dealing with a strategy that's probably oversold and uncommunicated, or rather undercommunicated, full of half-truths. Okay, that's a huge red flag. Whenever you see keywords that are misspelled, it kind of tells you who the target audience is for these strategies. And so I would be very, very careful with this strategy. But the point is, if you're gonna do infinite banking, fine. You can absolutely build up cash inside a life insurance policy. You can build up cash inside a whole life insurance policy. You can build up cash inside an index policy. It really doesn't matter. It really doesn't. They're all going to do the same thing in terms of building up cash and giving you the ability to loan money out of the policy and still earn interest on your dollars. What it ultimately comes down to in using life insurance this way is, what are you being charged for the loans that you're taking? And what is your predictable, or rather, what is your average return on the policy? Because in order for this strategy to work, you have to earn a higher rate of return on average than the loan rate that the company is charging you. I'll say it again. You have to earn a higher rate of return on your policy over the loan rate the company is charging you. Otherwise, you're making less on your money than they're charging you for the loan, and you're underwater. And so the problem with using whole life insurance for be your own banker, infinite banking concepts is typically the loan rate that they charge you to take money out of your contract is going to be higher than the actual performance of the contract. And so you're instantly underwater. And that's the exact same reason, but flipped on its head, as to why when we look at these Monte Carlo results, the numbers are so much better because we're loaning from a bank at 1.24. And of course, we're going to beat a 1.24 in just about every case. There's maybe 1 or 2 out of 5,000 simulations where we end up with less money. Well, that's because we're taking more risk and earning a higher rate of return. So let me just close with this. When it comes to infinite banking, and when it comes to using life insurance to loan out of your policy and pay for things or use it for supplemental retirement income, all of that is fine and well, and it absolutely can be done, and it absolutely does work. Like, you're not going to get in trouble from the IRS for loaning money out of your life insurance contract. You take a loan from your life insurance policy, more than likely, if the loan is within reason based on the cash value that you have, your policy is not going to just puff into smoke, right? It does work, but does it work better than all other alternatives that are available? And in my opinion, and I've seen thousands of infinite banking designs, in my opinion, I have not seen a design that works better than other financial alternatives unless you are absolutely not willing to take any form of risk. And by any form of risk, I suppose what I mean is, because an index policy has a fixed account just like a whole life policy does. So if you are unwilling to take any more risk than what you would take in a whole life insurance policy, then I suppose it may be the best strategy for you. But when properly explained and when people really understand how these different vehicles work, hardly anybody walks away thinking, I want that policy that's going to earn me 3.5% to 4%. That's what I want. Rarely do we hear that. And because of that, I think this infinite banking strategy is largely oversold. It's full of half-truths, and it's just not going to work better than something that you may actually have the capacity for risk on. So you may have more capacity for risk, and if you do, you should take more risk, because that's how it works. You're going to be rewarded ultimately with a higher rate of return. So hopefully this has been helpful. This is a Takedown Thursday on the strategy of infinite banking. If you're being pursued for infinite banking, if you've purchased an infinite banking policy, I would encourage you to have that reviewed, because chances are there's much better options out there available to you, unless you're just not willing to take any risk. And so if you want your policy reviewed, I'd encourage you to go to our website, leveragedwm.com/. You can go to IUL-review. That'll get you in our calendar queue. We'll take a look at the policy that you have, how it was sold, why you purchased it, what your goals were at the time and what your goals are now. And we'll do a full-blown analysis and see if what you have is actually the best thing for you and if it's actually going to accomplish your goals. So let me know what you think in the comments. Let me know if there's other sales strategies that you want me to take down on next Thursday, and I'd be more than happy to do that. If you haven't already subscribed to this channel, I would love for you to do so if you find this content valuable and helpful. And as always, I look forward to talking with you in the comments. And until then, I will see you next time.